£2,800. That's what HMRC took off a man I heard about last month out of a simple £10,000 pension withdrawal. He was owed almost every penny of it back. He had no idea. And here's the part that should worry you. Nobody at HMRC was ever going to ring him up and tell him. If you're retiring this year, or you've already retired, there are 8 things HMRC quietly expects you to sort out yourself. None of them arrive in a letter, none of them get explained to you, and missing even one of them can cost you hundreds, sometimes thousands of pounds. Stick with me, because the last one on this list affects almost everyone watching, and it changes in less than a year. I'm Thomas Ashford, and every week I dig through the rules that affect pensioners' money, the ones buried in small print that nobody bothers to explain in plain English. Let's start with the simplest one, and the one that causes the most damage further down the line. Tell HMRC you've stopped working. I know that sounds obvious, but here's what nobody explains. HMRC builds your tax code from information your employer or pension provider feeds them. The moment you retire, that flow of information changes, and HMRC often doesn't catch up for months. Your state pension is taxable, but it's paid to you gross, nothing taken off at the source. HMRC instead collects what you owe by quietly adjusting the tax code on your private or workplace pension. Get that wrong, and you're either overpaying every single month or quietly building up a tax bill that lands on your doorstep next summer. So call HMRC, or better yet, do it through your personal tax account, which I'll come to in a second. Use this exact sentence. I've recently retired, and I want to make sure my tax code reflects all my pension income correctly, so I'm not over or underpaying. That one sentence tells them exactly what needs checking. One quick note. If you're in Scotland, your tax code will have an S in front of it, something like S1257L. Same idea, slightly different rates. Now, the tool that makes almost everything on this list easier, your personal tax account. It's free, it's at gov.uk, and it takes about 10 minutes to set up if you have your national insurance number and either a passport or driving licence. Once it's running, this is where you check your tax code, your state pension forecast, your national insurance record, and any letters HMRC has sent. And if you moved house when you retired, update your address here too, because letters don't stop being sent just because you're not there to read them. If you take nothing else from this video, set this up. It makes every single other step easier. Now, before we go further, if this is useful to you already, hit subscribe now, because the next few points are exactly where people lose the most money without realising it. Point 3. The state pension. This catches more people than you'd think. Your state pension does not arrive automatically. It is claimed, not paid. The DWP sends you an invitation letter roughly 4 months before you reach state pension age, with a code on it. If you don't act on that letter, your pension is simply deferred. That can be a smart, deliberate choice, but it should never be an accident. The full new state pension this year is £241.30 a week, £12,548 a year. To get the full amount, you need 35 qualifying years of national insurance contributions. 10 years is the bare minimum to get anything at all. Once the letter arrives, claim online at gov.uk using the code on it. If you're within 3 months of state pension age and no letter has shown up, call the pension service directly. Your first payment usually lands within 5 weeks of claiming. I heard about a man, let's call him Brian, who reached state pension age and simply assumed the payments would start showing up on their own. They didn't. Nothing was lost, the claim was backdated, but he spent months worrying and planning around money that wasn't coming because he never actually claimed it. Don't be Brian. Point 4. And this is where HMRC's silence genuinely costs people thousands. When you take your first flexible withdrawal from a personal pension, or SIP, your provider almost never has your correct, up-to-date tax code yet. So they apply something called an emergency month 1 code, which assumes you're going to withdraw that exact same amount every single month for the rest of the year. So a one-off £10,000 withdrawal gets taxed as if you're about to take £120,000 across the year. Take someone drawing £10,000 from their pension with no other income that month. Under the emergency code, roughly £2,800 of that gets taken in tax. Their real tax bill, once you account for their personal allowance properly, is often close to nothing. That money is owed back to them. The remedy is one of three forms: P55, P50Z, or P53Z, depending on your exact situation, and all three can be submitted through your personal tax account. HMRC's stated turnaround is 30 days. And to give you a sense of just how common this is, HMRC repaid over £44 million to more than 13,000 pensioners in just the first 3 months of this year alone. And that's only the people who knew to ask. Now let's talk about the part almost nobody explains properly, the hidden allowances that stack on top of each other. Most retirees know about the £12,570 personal allowance. Far fewer know there are 2 more layers that sit on top of it. Stack all 3 correctly and you can have £18,570 of income a year, completely tax-free. Here's how it builds. Layer 1, the personal allowance, £12,570. Layer 2, the starting rate for savings, up to £5,000 of savings interest taxed at 0%. But here's the catch. That £5,000 shrinks by £1 for every £1 of other income above your personal allowance. Layer 3, the personal savings allowance, £1,000 for basic rate taxpayers, £500 for higher rate. Picture someone with a state pension of around £11,000 a year and £15,000 sitting in a savings account earning 4% interest. That's £600 in interest. Total income, £11,600. Tax bill? 0. The layers cover it entirely. Here's the part that catches people out. HMRC often estimates your savings interest based on last year's figures. So if you were taxed on savings interest 2 years ago when rates were higher, and you've since moved that money into an ISA, your tax code might still be punishing you for income you no longer even have. If that sounds like you, call HMRC and say, "My savings interest is now within my personal savings allowance and starting rate for savings. Please remove the savings income adjustment from my current tax code." That sentence alone can fix it. One thing worth remembering, ISA interest doesn't count toward any of these allowances at all. It's already completely tax-free, separately. Point 6, and this one genuinely frustrates me, marriage allowance. If one of you earns under £12,570 and the other is a basic rate taxpayer, the lower earner can transfer £1,260 of their unused personal allowance across. That cuts the higher earner's tax bill by up to £252 a year. It's been available for a decade, and you can backdate a claim by 4 tax years, meaning a couple claiming for the first time this year could recover over £1,000 in backdated payments, plus £252 going forward. HMRC's own estimate is that around 2.4 million eligible couples have never claimed it. The data sits right there in their systems. They know who's married, who earns what. They simply don't write and tell you. You have to ask. It's free to apply directly through the government website. The lower earner makes the claim, not the higher earner, which is the most common reason claims fail. And a word of warning, avoid the third-party companies that pop up when you search for this. They'll take 30 to 50% of your refund for something that takes 10 minutes to do yourself for free. Point 7, and I want you to listen carefully to this one. If HMRC believes you owe tax that PAYE couldn't collect automatically, they'll send what's called a simple assessment, reference PA302 at the top of the letter. Around 140,000 pensioners receive one of these every year, usually because their state pension has crept above the personal allowance. Here's the problem. The figures HMRC uses are often estimates, especially around savings interest, and you only have 60 days from the date on the letter, not the date you opened it, to dispute it. Once that window closes, you're paying whatever figure they've calculated, correct or not. So when one of these arrives, open it that same day and check every figure against your pension statements and bank interest summaries. 9 times out of 10, it's correct. The 10th time, it can be hundreds of pounds wrong. And finally, the last one. The one I'd want you to share with the people you love most. From the 6th of April 2027, less than a year from now, unused pension funds will be brought into your estate for inheritance tax purposes. That closes a rule that's been in place since 2015. For a decade, people were told to spend their other savings first and leave their pension untouched because pensions sat outside inheritance tax entirely. From 2027, that flips completely. The Treasury expects this change to affect roughly 8% of estates. There is a spousal exemption. Pension assets passing to a surviving spouse or civil partner remain exempt, but children and other beneficiaries do not get that protection. For context, the nil rate band sits at £325,000 per person, frozen until at least 2030. The residence nil rate band adds £175,000 per person if your home passes to a direct descendant. Together, a married couple with a home can pass on up to £1 million inheritance tax-free. Above that threshold, it's taxed at 40%. There are also annual gifting allowances worth knowing. £3,000 a year as a standard gift exemption, with 1 unused year carried forward. Smaller gifts of £250 to as many people as you like, and larger one-off gifts for weddings. If you're someone drawing more pension income than you actually spend, it's worth having a proper conversation with a regulated financial advisor about this, sooner rather than later, because the rules are changing and 2027 is closer than it feels. Here's what connects all 8 of these. HMRC never writes to tell you about marriage allowance. The DWP never rings to remind you to claim your state pension. Your pension provider never volunteers the fact they're about to apply an emergency tax code. The entire system runs on what you ask for, not on what you're actually owed. So here's your simple checklist. Tell HMRC you've retired, set up your personal tax account, claim your state pension, reclaim any emergency tax overcharge, stack your savings allowances properly, claim marriage allowance and backdate it, read any simple assessment letter the day it arrives, and start the inheritance tax conversation now, while there's still time. None of this needs doing in one afternoon. Pick the one most likely to apply to you and start there. If you found this useful, that means someone you know probably needs to see it too. Hit subscribe so you catch next week's breakdown. Tap the bell icon so you don't miss it, and please, share this with your family and friends, especially anyone who's recently retired or about to. I'm Thomas Ashford. Take care of yourselves and take care of your money.